So the aim of this video is to help a new investor, a novice person who's looking to grow their wealth over time, to navigate through the ferocious waters that is the stock market and the world of investing. In this video, I'm going to go through the absolute basics from picking a broker all the way through to what I look for when I pick my stocks, and also give you some red flags along the way. I tend to put out this video from time to time to help out my fellow Brits who tend to have not as much investing material available to them, but nonetheless, if you're not British, I still think you will find this very beneficial to you. And if you're a new investor, a lot of this still does apply to you. Now, what I ask from you is, if you are watching this, please do help me out. Help me reach a larger audience. Make sure that like button is turned whatever color your device allows. It does seriously help this channel grow, and your help with this would be much appreciated. Now, if you clicked on this video, it's probably because you want to make millions in the future. You want to make money through investing, and in the stock market specifically. Now, let's talk about the two key things before we move into the in-depth things I want to talk about in this video. The first thing is, there is two different things when it comes to the stock market. You have trading and you have investing, and they are very different things. Stock market trading, or day trading in general, is where you look at a chart and you're in a stock for a short period of time. In this video, I'm not really going to cover the day trading and the stock trading, but that video up there will probably help you out. This video is going to be more focused on people who want to buy a company and hold it for a long time and grow their wealth in a safer manner, and eventually, hopefully, reach financial freedom. This is a much safer approach, and I feel that with investing, especially regular investing, you have a much better chance of reaching this financial freedom and maybe one day calling yourself a millionaire. So the first thing we need to talk about is you need a stock broker. Everybody, if you want to buy stocks, you need a broker or a platform to do so. Now, there's many out there. It depends where you're watching from. You have Robinhood, Webull, eToro, Interactive Brokers, Saxo Bank, and I myself have literally over 10 of these platforms to choose from. Now, this is mainly due to me having enough funds to do so, but also having the diversification through individual brokers. Now, my favorite personally is Interactive Brokers, but only for large amounts because it's not cheap to use. My second favorite for a big amount is probably Saxo Bank, but probably my overall favorite, and I'm growing more and more fond of as time goes on, it's eToro. And if you want to use eToro, there's a link down on the pinned comment, and if you sign up using that link, you get lifetime access to our Discord. Now, it does sound like it's a paid promotion, and to be clear, it sort of is. I get a kickback if somebody does sign up on that, but genuinely, I do have several accounts of eToro, and I use them more and more as time goes on. If you're a new investor, the reason why I selected eToro over Interactive Brokers and Saxo Bank is, first thing is, they're much easier to use. Interactive Brokers is a minefield in itself, and also it's a lot easier. You simply just download an app, deposit, and you can go ahead and make a trade, and the minimums are much less too. So if you are starting out, then I strongly suggest maybe just checking out eToro or one of the other apps you can download on your iPhone and start off very small. So let's say you've selected your broker, you've funded your account, and you're about to YOLO into some stock with leverage. First thing, as a rule, never use leverage. Even if you're an experienced investor, you do not know what you're doing if you're using leverage. Leverage is only good for people who have enough money in the bank to actually utilize the leverage itself. A lot of new investors and day traders and stock traders in general leverage themselves up, and eventually what's called a blow up will come, which is where your account completely blows up and you lose everything, and in some cases even all your broker money. As a rule of thumb, just trust my word for it, never ever use leverage. Now, on that as well, there's a big disadvantage for new investors and traders with you clicking on this video. The first thing is, you probably clicked on this video because you want to learn about something to do with the stock market or how to actually invest yourself. And you're at a disadvantage here because the chances are somewhere on the suggested videos, it's going to be buy these 5 stocks now, or these stocks will 10x in the next year. As a rule of thumb, if you're looking for advice on social media, you're probably going to be lied to at some point. Now, I know it's counterintuitive for me here, but I always try and give you the bear case more than the bull case as much as possible on this channel. So if you like the more honest approach, maybe consider subscribing. But my point here is don't go on what some other bloke, even if he's got a beard as good as mine, is telling you on the internet. Go and do your own research, and never buy a stock just because somebody is saying it's a good investment online. Everybody, literally everybody, has an agenda on anything they ever talk about. So just take that with a pinch of salt. And that brings me on to a very key point. When you're buying any investment, any company, you need to realize you're buying a company. You're not buying a price on a chart. You're buying an actual business, And the fundamentals of that business is the most important thing when it comes to investing. It doesn't matter about the stock price, it doesn't matter about the chart, and it doesn't matter about what some bloke is telling you the story of this company is. The only things that should matter for investors at the beginning is the fundamentals, and you should be as negative as you can be with every single investment. Think about it logically. You've worked hard to get this money to put it into a brokerage account. It's your money. You're trusting a stranger to grow it for you. Even if you buy Apple, you don't know Tim Cook personally, but you're trusting that bloke to do well and make sure Apple grows over the long period of time. Why would you trust some bloke you've never met if you have not done your proper research? That's my point. Be as negative as possible. Which brings me on to the first thing where investors sort of mess up. And I did this originally when I was about 17 myself, and I know a lot of people still seem to do it. We see them in the chat room as well. They look at a stock chart and they see that it's fell 50%. And it's got to go back to its all-time highs at some point. It might take a year, but 50% is 50%, people. It's the wrong thesis. It's completely the wrong approach, because there's a lot of things that I'm going to talk about in this video why the stock will never recover, quite frankly. That is something called dilution. I'll come on to that in just a second. But if we look at a company called Cisco. Now, Cisco, if you've never heard of them, that's fine. But they are a huge tech company. And I mean absolutely massive. They're 250 billion worldwide, thousands of employees. And in the dot-com bubble, they fell from $70 all the way down to $10. Yes, an absolute staggering fall. Here we are 20 years later. In fact, more than 20 years later, and they still have yet to break that $70 mark. In fact, if we go back to the dot-com bubble, majority of companies, like 96% of them, are not around anymore. So this is the point I'm saying. Just because you see it falling on a chart, definitely, in fact, if you ever see a stock falling 50%, there's probably a reason for it. And if you can't justify it with the financials, then it's probably just in a complete avoid. So just because you see a stock falling on the chart, definitely do not buy it just because of the chart alone. Now, when writing the sort of script that I go off for this video, I was thinking, how do I help the novice investor? What advice would I give somebody who is just starting out? Let's say they've got $1,000. Where would they invest it? I could give you stock picks, which isn't helping. Give a man a fish, teach a man to fish, and all that. But my whole thing is why not tell you what to look for and how not to pick a stock? Because first thing is you need to look at the financials. I've pretty much made that clear throughout the video. But the biggest thing that I think you should look at is in 4 key sectors. Now, when I buy a stock, there's a lot more than 4. There's about 20 things I look at. And if you want to see what all of them are, let me know down in the comments. I'll try and do a full video on the full process of me picking a stock. But there are 4 big things that if I see they don't play out the way I want them, then it's probably an instant no-no, and I'll move on to the next company. It saves a lot of time, and that way I don't have to read or research the individual story of what the company's going to do and spend hours upon hours, because if the company's in complete financial shambles, it's not worth an investment anyway. So why waste the time finding a story of a company if I'm not going to buy it because their financials are pants? The financials actually take a couple of seconds to look at, maybe a couple of minutes at best. So this isn't one of the 4 criteria, but it's something that I think every investor should be aware of. The price of a company is irrelevant on the chart. So if you see Apple's at $500 or whatever it is, a couple of $100, Tesla's at $1,000, it doesn't matter. It really doesn't matter. The only thing that matters is the thing called the market cap. Now, the market cap is the total value of this company. If you sold all the shares, all their assets, this is the value, the estimated value that the market is pricing this company at. That is how much you pay for the business. Now, of course, you're not going to buy all the shares of Apple. You're only going to buy one. But if you've got all the shares in the market that were available to be purchased and times it by the stock price, you're pretty much at the market cap. So it's a much more logical way of valuing a company, and that's what everybody should be looking at, not necessarily the stock price. Now, the key with finding out a company's market cap is we then have something to go off, and we can assess whether we feel this company is fair valued. So Apple, as an example at the recording of this video, is valued at $2.8 trillion US dollars, and we can use that number to see if we feel that's a fair price for the total business, rather than just look at the share price, because every company has a different amount of shares available, different assets, so it's not really fair to use the stock price. The market cap is a much more sensible metric when it comes to valuing a company. Our aim as investors is to buy a company that is undervalued in terms of its financials and wait until it becomes fair value or overvalued to sell it, and that's where we make money. Now, for the 4 main key criteria that I would say start looking at if you're a new investor, I'm going to be using a website called Doco, and I think I'm pronouncing that right. I have no idea. The reason I'm using it, and I usually use a different website, but it's paid for, this website's actually free, and this is why I feel it's beneficial to a new investor. Now, if we go on Doco, you can create an account. Like I said, it's absolutely free. You can put your ticket in here, and we're going to use Apple. So Apple's going to come up and you've got this basic sort of data we can see. And the market cap down here is labeled, like I said, 2.81 trillion for the market cap of Apple. If we click the financials, and that brings us into the first thing that I look at, and this is the most important thing that I look for with any company, because this is the biggest thing that I think every investor misses out on, and that is the shares outstanding and dilution. Like I said, if you got all of the shares in the market of Apple times it by its stock price, you've pretty got to the market cap. But companies, if you didn't know this, can raise money by adding more shares to the market to fund a project or pay off their debts. We've seen this with stocks like AMC recently, where if they sell 1 million shares at the current price, they generate a lot of money to pay down their debts or just keep cash for a rainy day. The downside of dilution for you as an investor is, let's say we have Apple and they only had 5 shares on the market and you happen to just own 1, which would be very nice because you own 20% of Apple. But you'd own 20%. Now, if they then go ahead and add another 5 shares to the market to raise capital for a project or something along them lines, you still own your 1 share. Now, that 1 share is not 20% anymore, it's now only 10. So as time goes on and companies dilute you more, well, actually, it's not good because your share ownership of the company is actually going down, which means over time, your value should in theory go down too, unless the company grows at a faster rate in which it's diluting. So if we go down here on Doco, we can see that the basic average shares, which is also known in most reports as shares outstanding or the float, we can see that Apple has been doing the inverse. They've actually been buying back shares of Apple. So it's a big tick in the box here because they're rewarding investors for hanging around. So in this scenario here, let's say you had 10% and they bought back 5, your 10% goes back to 20%. It's actually a good thing when companies buy back shares. So that's a big tick in the box for Apple. Now, another thing that I like to look at here, which is point number 2, is the total revenue. Now, what we want to see here is we want to see the total revenue going up over time. And here we can see every year that Apple's revenue pretty much is going up. From 2017, 229 billion, 265, a little dip there, 260, 274, then a whopping jump from 274 to 365. Insane revenue growth. Now, what revenue is this is how much money the company has got from selling its product, from selling iPhones, Macs, etc. That's how much money the company has physically took in from subscriptions, sales of iPhones, and yada, yada, yada. Now, the reason why this is important, we want to see this number growing over time because it means the company is, in generic terms, growing as well. But that metric ties in with the third metric I want to talk about, and that is net revenue. A lot of companies can generate, we see this a lot in EVs lately, can generate a lot more revenue as time goes on, but their net income can fall as well, or their net profit. If we go on here, we can see that their net income for Apple is also very good. It's gone from 48 billion to 59 to 55 to 57 to a whopping 94 million. We want this figure also increasing as time goes on. The difference between revenue and net income, if you're still not following, is very, very simple. It is, if you sell an iPhone for $1,000 as an example, it's not $1,000 of profit. It costs money to pay the person to make the iPhone, for the materials of the iPhone, and also maybe some other stuff along the way like transport. So it's the cost of doing business. The net income, let's say it's $100 on one iPhone, would mean that they make $100 of net profit on said iPhone. But that is not the final figure that a company gets to take home, because the net income figures can be manipulated quite a lot from clever accounting. They can also defer taxes and do a lot of other things with net income. It's just a very basic way of seeing if a company is at least heading in the right direction. And that brings me on to the big daddy of them all, number 4, which is free cash flow. If we go on Doco and we click cash flow on the right there, we can see and go down to the free cash flow. Now, this is very, very important because it's not very easy to manipulate. Now, free cash flow is different to net income because in the net income, you're going to be taxed on it, and there's a lot of other capital expenditures like maintenance or upgrades to the office or bonuses, something along them lines. The capital expenditures of a company are then took out of the net profit. Now, the free cash flow is exactly what it sounds on the tin. The FCF, free cash flow, is what's left over at the end of the year or the end of a quarter to reinvest into the business, and you can use this money to buy back shares, pay a dividend, buy a new company, make acquisitions, or even just fund another project to grow the company. Free cash flow to me is the most important figure when it comes to looking at a business to buy. I want to see this figure growing steadily. I don't want to see big jumps in free cash flow. I want steady growth over a long period of time before I ever invest into a company. Now, the free cash flow at Apple has gone from 51 billion to 64 to 58 to 73, then a massive jump to 92. So as expected, Apple's in a great free cash flow situation. Now, of course, with this 4 criteria, it doesn't necessarily mean a company is definitely a buy or not a buy. Of course, there is always exceptions to the rule. These are just the things that I think every new investor should be really looking at before you put your capital on the line. My whole stance and thesis on any investment is look at this first and then look a little bit further if it lines up. If I really, like, for example, if Alibaba is a company I really like. Alibaba fell 60%, if you didn't know, or something along them lines in the last year or so, but its free cash flow, its margins, its revenues, its net income is actually increasing, albeit dilution is slowly happening. They've started to buy back shares now, but over the last couple of years, it hasn't really been that good. They have been selling more shares, but it was justifiable from the insane growth on their balance sheet. So it's not an exact science, but I would look at that first and then go and research the company because it's damn interesting. If I found out Alibaba was going to be the biggest cloud computing company on planet Earth, I could then look at the dilution and say, yeah, that's justifiable. That's not our job as an investor. It's to be as negative as we can be and as careful as we can be with our own money, which we've worked hard for. So let's say a stock has ticked all these boxes and we love it. We love the story. We love everything about it. Should we just jump in with 2 feet? Absolutely no. We should not buy this company on that alone. The way I tend to do it is I like to throw a test out. So let's say we have that $1,000 we talked about earlier and we're going to allocate $100 to Alibaba as an example. I would then go and buy $10 of Alibaba pretty much instantly if I'd done my research and was happy with it. And then I'd pray to the gods that Alibaba fell. And it did in this scenario, like I said, and I'd continuously buy into every big drop, provided the financials still make sense, the news still makes sense, and I can justify why it's falling. In Alibaba's case, it's down to regulation fears, which the company can literally do nothing about. So eventually, the market will correct and Alibaba will go up. In my opinion, you shouldn't take that as financial advice. But the point here is if I went and put that whole amount of money, that $100 straight into Alibaba, I'd be now down to $40 or whatever it would be on the chart. And I'd really be suffering through this time thinking I've made the wrong decision. But having cash on the sidelines, knowing that I want to allocate more money to it, it just represents a much better buying opportunity. And psychologically speaking, when you get to that mentality, we try and stress this in the chat room, it's starting to work on a few people, is that when a stock falls, provided your thesis is right, you've researched the company and everything's still the same, all you're getting is a discount. And that's what I would say to new investors. But please do not mistake this for buying a company on the way down on the chart. That is different. The financials need to perfectly align and the story needs to be good before it makes sense. Now, one final word of advice to a new investor or somebody who's just starting out in the stock market. A final word of wisdom is do not be afraid to admit you're wrong. And this is really important because I think a lot of new investors will go down 80% on an investment at some point. In fact, pretty much most will. And then they'll say, well, I might as well lose it all. Hopefully it goes up one day. But if that 80% goes up and you're only down 50%, you're still not going to sell it. That's the point. You're better off just realizing a loss. Some of the best investors of all time only win 50% of the time or even less. It's just their winners are much bigger than their losers and they're willing to cut a loser. If you're in a company and some negative news comes out, and if you're honest with yourself, can admit this is pretty damn negative, then you should be looking at selling the stock unless your thesis originally is still in place. Be prepared to have losers in the stock market. There is not an investor in the world that is right all of the time. The only investors that survive are the ones who are willing to admit they're wrong and to move on to the next company. So that is my biggest word of wisdom I can give to anybody starting out in investing, day trading, or anything in life to do with money. Always be prepared to move on from a bad investment and find the next one. That's what makes the difference between a good investor and somebody who really isn't an investor or not going to be one much longer. If you found this video very helpful, please do double check that like button is turned blue. If you want to learn something more on value investing, check out that video up there. I go through the process that I go through when picking a stock, and also if you could drop down the code word down in the comments, which is beginner investor, it would greatly help me out with the YouTube gods. Don't forget eToro down in the pinned comment. If you use that link, you get lifetime access to our chat room. See you in the next one. All the best. Peace.